Imagine losing over $7 trillion.
Wow.
That's the estimated amount of home equity
Yeah.
U.S. households saw just vanish from their balance sheets. Started late 2006. Took just over 3 years.
7 trillion. It's hard to even grasp.
Exactly. And that figure, it's not just a number, right? It represents this massive shock, a real jolt to the financial system. It gives you a visceral sense of the scale, the impact an economic downturn can actually have.
Yeah, absolutely.
Welcome to the Deep Dive. Today, we're really plunging into the anatomy of U.S. recessions. We've gathered a pretty rich stack of sources for this. We're digging into research papers, economic articles, looking at some compelling historical data.
Yeah, quite a mix.
And our mission here, using these materials as our guide, is basically to cut through the complexity. We want to pull out the most important sort of knowledge nuggets, help you truly understand the mechanics of these critical economic periods.
Make sense of it all.
And leave you better informed about the subtle signs, and maybe the not-so-subtle signs, that often signal they're coming. Plus the profound, and often very uneven, impacts they unleash across the economy and on different groups of people.
Right. And how long they typically stick around.
Exactly.
Yeah.
Think of this deep dive as, your essential shortcut to being well-informed about what really happens when the economy tightens its belt.
And we're going to do this by, unpacking the core data, connecting those historical examples to what we understand now, and sort of synthesizing the expert analysis that's presented in these materials.
Right.
Because predicting the precise timing of a recession, that's famously challenging, often called the economist's equivalent of searching for the Holy Grail, basically. But understanding the patterns, the indicators, and the mechanics of the downturn itself, that's absolutely fundamental if you want to navigate these inevitable cycles.
Okay, let's dive right into that prediction challenge then. Why is it so notoriously difficult? What makes it this Holy Grail quest for economists?
Well, it really boils down to the economy's inherent complexity. It's not some simple, predictable machine where, X input always gives you Y output on a neat little schedule.
Right, not like physics.
Not at all. You've got this vast dynamic system. It's influenced by countless factors, sure. Domestic policy decisions, central bank actions, yes. But also completely unforeseen geopolitical events, rapid tech advancements, big shifts in consumer behavior, global economic forces.
All interacting.
All interacting in ways that are just incredibly difficult to model and forecast with anything close to perfect accuracy. So, relying on any single signal to predict the future with certainty, that's just fraught with peril.
Understood. So no single crystal ball. But there are these powerful signals we watch, right? Indicators that have historically popped up before downturns, acting as these potent red flags, as one of our sources put it. And maybe the most talked about, the one that gets the most airtime in financial news, seems to be the yield curve inversion.
Absolutely. Yeah, that signal comes directly from the bond market, specifically from Treasury bonds, which, everyone sees as relatively risk-free. Now, normally, investors demand a higher rate of return, a higher yield for lending their money out for a longer period compared to a shorter one.
Makes sense. You want more for tying up your money longer.
Exactly. You want to be compensated more for locking up your capital for, say, 10 years versus just 3 months. So the typical yield curve slopes upward. Long-term bond yields are higher than short-term bond yields.
Okay, so that's normal. And an inversion is when that relationship just flips completely upside down.
Precisely. The short-term yield actually rises above the long-term yield.
Feels totally counterintuitive.
Yeah.
Like gravity suddenly reversing.
Yeah.
Why does that happen, and why is it such a potent warning sign?
It happens when bond market participants collectively start anticipating that future interest rates, particularly the rates the Federal Reserve controls, are going to fall significantly.
Okay, but why would rates fall?
Because the Fed is expected to cut its benchmark rate, the federal funds rate, precisely because it's anticipating or maybe already reacting to a significant slowing of the economy, perhaps even a recession. And it needs to stimulate activity.
I see.
So an inverted yield curve is basically the bond market placing this massive collective bet on a weaker future, weak enough that it's going to force the Fed's hand into lowering borrowing costs.
So it's the market pricing in future economic pain and the central bank's likely reaction to that pain.
Exactly. And the sources, they highlight specific yield spreads that economists and analysts watch really closely. The difference between the 10-year Treasury yield and the 2-year Treasury yield is super popular. You hear about it all the time.
Yeah, that one's everywhere.
But some, including researchers actually at the Federal Reserve, tend to favor the spread between the 10-year Treasury and the 3-month Treasury bill. They cite its slightly stronger historical predictive track record.
And that historical track record, it really is quite compelling, isn't it? The sustained inversion in these key spreads has preceded every single U.S. recession since the 1970s.
That is a remarkable pattern. It's one of the most consistent, albeit still imperfect, recession signals we have.
Right.
The lead time, though, between when a sustained inversion starts and when the recession officially kicks off, that's not fixed. It typically falls somewhere in the range of, say, 6 to 24 months.
So it gives you a warning, a kind of heads up, that the risk is elevated, but not a precise date on the calendar.
Exactly. It's a heads up.
And critically, as the sources point out, it's a powerful red flag, sure, but it's not an ironclad guarantee. Market expectations, even collective ones, can be wrong.
Absolutely. The economy is complex enough that other factors can always intervene, right? They might prevent a recession from actually materializing even after the curve inverts, or maybe just shift the timeline around. It reflects collective pessimism, definitely, but that pessimism doesn't always translate one-to-one into an official NBER-defined recession.
Okay, let's shift from bonds to stocks now. The stock market is often described as being forward-looking. What signals might we see there indicating trouble ahead?
Yeah, the stock market is often seen as trying to discount the future, pricing in expected future corporate earnings, economic growth, overall investor sentiment. So when investors collectively get fearful about the future economy and what it means for corporate profits, they tend to pull back from riskier assets. They sell stocks.
Right.
This leads to significant, sustained market declines. We talk about bear markets typically defined as a 20% or more drop from a recent peak. These frequently precede or coincide with recessions.
And what about the VIX index, the so-called fear gauge? Does that play a role?
It does. The CBOE volatility index, the VIX, it measures the market's expectation of future volatility based on options traded on the S&P 500 index.
Okay.
During periods of high uncertainty, fear, stress in the market, the VIX tends to spike dramatically. This often happens as recession fears are mounting or as a downturn is actually unfolding.
But like the yield curve, the stock market isn't a perfect crystal ball either, is it?
Oh, far from it. The stock market can be incredibly volatile. It's prone to overreactions based on, news headlines or sentiment swings that don't always reflect the fundamental economic reality.
Right.
There's that old joke, you mentioned it, the stock market has predicted 9 of the last 5 recessions.
Yeah, I've heard that one.
It really highlights its tendency for false alarms. You can have significant market drops without a full-blown recession following.
Okay, so yield curve, stock market.
Yeah.
What about the actual flow of money through the economy? How do credit conditions signal potential trouble?
The availability and the cost of credit are just fundamental to economic activity.
Sure.
When lenders, especially banks, start getting nervous about the economic outlook, worried about the ability of borrowers, both businesses and consumers, to repay loans, they instinctively tighten their lending standards.
They get cautious.
Exactly. More cautious, they might demand higher collateral, increase interest rates, add fees, basically compensate for what they see as higher risk.
Which then makes it harder and more expensive for businesses to invest or for us consumers to make big purchases like cars or homes.
Precisely. This tightening credit environment can act as a significant drag on the economy. And we can observe this tightening in various ways. One key signal is widening credit spreads.
Okay.
That's the difference in yield between riskier corporate bonds, say, those rated BBB, or maybe lower and safer government bonds like treasuries. When that spread widens, it means investors are demanding a much higher risk premium to hold corporate debt. That signals increased concern about corporate defaults happening in a weaker economic environment.
And I guess surveys of bankers can give a more direct read on this, too.
Yes, things like the Federal Reserve's Senior Loan Officer Opinion Survey, the Aleslos report. It provides direct insight into whether banks are reporting that they are tightening lending standards across different types of loans.
Yeah.
A significant tightening reported in those surveys is a strong signal that credit is becoming less available. And that can indeed starve the economy of the funds needed for investment and consumption, potentially pushing it towards or even into a recession.
So is the smart approach just to pick the indicator you like best, maybe the yield curve because of its track record, and just base your outlook entirely on that?
Absolutely not. No, the sources are very clear on this. Relying on any single indicator is just too risky. It can lead to false signals or, missed warnings. The most prudent approach, as it's emphasized in the materials, is to look for a confluence of warning signs.
Like a doctor diagnosing an illness.
Right.
You need multiple symptoms, not just one.
Exactly that analogy. A single elevated temperature isn't enough for a diagnosis, but a fever combined with specific lab results, maybe a distinctive cough, other symptoms that pattern points much more reliably to a particular condition.
Makes sense.
Similarly, an inverted yield curve coupled with a significant stock market downturn and reported tightening in bank lending standards, perhaps falling consumer confidence or a noticeable rise in initial unemployment, claims that whole combination creates a much more compelling picture of an impending economic slowdown. It's really the pattern across multiple diverse signals that matters most.
Okay, so we watch the signs, always looking for that confluence. But let's say the signs align, the warnings flash red, and the economy actually enters a downturn. What actually happens during a recession? Let's break down the anatomy of the contraction itself. First, how is a recession officially defined here in the U.S.?
Right. In the U.S., the official call is made by the Business Cycle Dating Committee of the National Bureau of Economic Research, the NBER.
Okay, NBER.
And they define a recession not just by a specific number, but more broadly. They call it a significant decline in economic activity that is spread across the economy and lasts more than a few months. They look at several key indicators simultaneously to make that determination.
Which indicators do they actually consider? What's on their checklist?
They look at real gross domestic product, GDP, of course, real income, employment figures, specifically non-farm payrolls, industrial production, and wholesale retail sales. They assess the depth, the diffusion, meaning how widespread it is across different sectors, and the duration of the decline across all these measures.
So that common rule of thumb we always hear about, 2 consecutive quarters of negative GDP growth, that's actually not the NBER's official definition.
That's correct. Yeah, while 2 consecutive quarters of negative GDP is a useful, often cited shorthand, and it frequently does coincide with a recession, it's not the formal, official rule the NBER uses.
Interesting.
They take that broader look at multiple indicators to get a more complete picture of the economy's overall health. There have actually been instances where the NBER declared a recession without 2 strict consecutive quarters of negative GDP, or vice versa, although it's pretty rare.
Okay, so how long do these contractions typically last? Is there a standard length?
Not really standard, no. The duration of U.S. recessions has varied quite a bit throughout history. Looking at the data in our sources, they can range from relatively short to quite prolonged.
Give some examples.
Okay, the recession back in 1948 lasted 11 months. The downturn in 60-61 was about 10 months. Then we saw longer ones in the 70s and 80s. The 1973-75 recession went for 16 months, and the 81-82 recession also lasted 16 months.
Right, those were tough periods.
They were. More recently, the 2001 recession was shorter, just 8 months.
And the Great Recession, the one that looms so large in recent memory.
Ah, the Great Recession. The NBER dated that one from December 2007 to June 2009, so 18 months.
Wow, 18 months.
Yeah, that made it the longest U.S. recession since the Great Depression back in the 1930s. So there's significant variability, but yeah, the Great Recession set a modern record for duration.
And during these periods, GDP, the total output of goods and services, it shrinks, right?
By definition, yes. Economic activity contracts. The magnitude of that decline also varies quite a bit.
How much does it usually shrink?
Well, the 1948 recession saw a modest 2% drop in GDP. 60-61 was negative 2.4%. The 1973-75 recession saw a larger decline, negative 3.4%. 1981-82 was even bigger, negative 3.6%.
Okay.
The 1990-91 recession was shallower, only 1.5%. And the 2001 recession was actually very mild in terms of GDP decline, just mitigator 0.3%.
And the Great Recession's GDP hit.
The overall GDP decline for the Great Recession period was around 2.58%. Although, it's worth noting, as a comparison point, some quarterly drops in earlier recessions, like the really sharp negative 1.8% decline seen during the 1982 recession, which, remember, happened during that high inflation, stagflation era, making it particularly challenging that highlights that even shorter recessions can involve really intense contractions quarter to quarter.
Right. Now, the impact people probably feel most directly, most acutely, is on jobs. Unemployment inevitably rises during a recession.
It's absolutely one of the defining features. As businesses face falling demand, maybe tighter credit, other economic shocks, they cut back on production and services, and unfortunately that leads to layoffs.
Yeah.
So the unemployment rate rises, often sharply. Looking at the peak unemployment rates cited in the sources during past recessions, 7.9% in 1949, nearly 7% in 60-61, 8.8% in 73-75, over 10% in 81-82.
Over 10%. Wow.
Yeah, 6.8% in 90-91 and 5.5% in 2001.
And during the Great Recession, where did it peak?
The unemployment rate peaked around 10% in 2009, which was actually similar to the peak hit during that really challenging stagflation period of 1982. It just underscores the severity of both those downturns in terms of job losses.
You mentioned Okun's law earlier. How does that fit in here, relating unemployment and output during these times?
Right, Okun's law. It's an observed empirical relationship between unemployment and output. Basically, it suggests that for the unemployment rate to fall, the economy's actual growth rate needs to be faster than its potential growth rate.
Okay.
Essentially, you need pretty robust economic expansion just to absorb new workers coming into the labor force and bring back those who were laid off. However, as the sources note, estimating the economy's theoretical potential growth rate is actually really difficult and imprecise.
Which makes applying Okun's law for, like, precise policy target setting quite challenging in practice.
Got it. Beyond just the immediate job loss, there are these significant extra costs associated with rising unemployment during a recession, aren't there? It's not just a temporary state. There seem to be lasting effects.
This is a crucial point that often gets overlooked in just the headline unemployment number. Unemployment can create this negative feedback loop. It can be almost contagious in a way.
How so?
Well, when people lose their jobs, their income falls, right? So they reduce their spending. That lowers demand for businesses, which then potentially leads to more layoffs elsewhere in the economy. It can fuel this downward spiral.
A vicious cycle.
Exactly. And crucially, the risk of long-term unemployment increases significantly during and after recessions. The longer someone is out of work, the harder it becomes to get back into the labor market. Skills can atrophy, professional networks shrink, there can be employer biases.
Yeah, that makes sense. The sources cite data showing that after the Great Recession, only about 35% to 40% of those who lost their jobs were actually reemployed full-time by January 2010. That's months after the recession officially ended. Reemployment rates, especially for full-time work, remained stubbornly low for years for those displaced workers.
And the financial cost for those individuals, even if they do find another job eventually, it's substantial.
It's enormous. One source highlights that men laid off when the unemployment rate is below 6% lose, on average, about 1.4 years of their prior earnings over their lifetime.
Wow.
But if they get laid off when the unemployment rate is above 8%, that loss doubles to nearly 3 years of earnings.
That's a huge difference.
It is. So being unemployed during a high unemployment recessionary environment has a much deeper, longer-lasting impact on an individual's lifetime earnings potential. And this prolonged unemployment also has broader societal costs, impacting public health, the economy's long-term productive capacity.
Right. It's interesting to note, though, that the very brief COVID-19 recession was kind of an anomaly in this respect, with employment recovering relatively quickly compared to history.
It was quite unique, yeah. Largely due to the nature of the shock itself, a public health crisis causing a sudden stop, followed by absolutely massive targeted fiscal support. And then you had that subsequent rapid rebound in demand and a very tight labor market. Historically, the employment recovery typically lags the official end of a recession significantly, sometimes by years. So the COVID experience really stands out.
Okay, let's shift gears slightly to consumer behavior. Consumer spending is like the engine of the U.S. economy, right?
Yeah.
Making up around 70% of GDP back in 2008. How does our spending change during a recession, and what did we learn from the Great Recession specifically?
Changes in consumer spending are absolutely critical drivers of business cycles, no question. In severe downturns, spending declines meaningfully. That directly translates into reduced demand for businesses, which further exacerbates the downturn and can potentially undermine the prospects for recovery. One of the Stanford sources provides a really fascinating, detailed look at consumption during the Great Recession. They used granular per capita data, adjusted for inflation, seasonally adjusted, and then normalized everything to 100 right at the start of the recession.
Okay, so what was the overall trend they observed for per capita consumption during that period?
They found that average per capita consumption declined steadily or monotonically, basically throughout the recession until around the middle of 2009. Interestingly, per capita disposable income actually saw an initial increase in early 2008, partly due to government transfer payments like those stimulus checks.
Right.
But then it fell sharply from late 2008 onwards as the recession really deepened and job losses mounted.
And was the decline in spending uniform across all types of goods and services? Did we cut back everywhere equally?
Not at all. No, there was significant heterogeneity, which is a key insight. Spending on durable goods, those big-ticket items, cars, furniture, appliances, that fell substantially.
Makes sense. Those are easier to postpone.
Right. Spending on non-durable goods, things like food, clothing, gasoline, that fell more moderately. Spending on services, somewhat surprisingly, also declined monotonically throughout the recession, but at a much slower rate than either durables or non-durables.
Was that behavior of services spending typical compared to past recessions? You said it was surprising?
This is where the Great Recession was quite peculiar, yeah. In previous U.S. recessions examined in the sources, the recovery in services spending often provided a crucial buffer. It helped prop up total consumption and aided the overall recovery.
Okay.
However, in the Great Recession, services spending not only declined continuously, but it failed to recover at all within the data period analyzed by this particular source, which went up to mid-2011.
This lack of recovery in services consumption was a real standout and concerning feature of that specific downturn.
Wow. So what explains these significant changes in these variations in consumption during the Great Recession? The sources point to several factors interacting, right? Yes. They identify 4 primary drivers. First, and perhaps most significantly, given the nature of the Great Recession, was the wealth effect.
Okay, explain that.
This is the economic principle that changes in household wealth can influence consumer spending. The Great Recession saw, as we mentioned, unprecedented wealth destruction, primarily from the collapse of the housing bubble and that sharp decline of the stock market in 2008. This massive loss of wealth significantly impacted consumption, particularly, as we'll discuss in a bit, for wealthier households who hold a larger share of these assets. Losing that wealth just makes households feel poorer, less secure, and leads them to cut back on spending to try and rebuild their savings.
Okay, so the wealth effect was a big one. What's the second factor?
Second was increased uncertainty and declining confidence. The financial crisis created this environment of extreme uncertainty about the future of the economy, about job security, about the financial system itself. Consumer confidence just plummeted to historically low levels.
Yeah, I remember that.
This profound uncertainty made households much more cautious about spending. They delayed or just skipped non-essential purchases. And consumer confidence also took a very, very long time to recover after the Great Recession ended, which likely contributed to the sluggish recovery in spending overall.
Makes sense. And the third factor?
Credit restrictions. The financial crisis led to a significant tightening of credit conditions across the board. Banks, other lenders, they just pulled back, made it much harder for consumers to access credit for those large purchases like cars and appliances, which disproportionately hit durable goods spending. Even consumers with good credit found it harder or more expensive to get loans.
Right. Credit dried up. And the fourth factor?
Consumer incentive programs, things like the Cash for Clunkers program, officially the car allowance rebate system, or CARS back in late 2009. These provided temporary incentives for consumers to buy new vehicles.
Yeah, I remember that too.
The sources note these programs can cause these temporary spikes in specific spending categories. Though analyzing their precise aggregate impact is complex, might need more granular microdata, which wasn't fully available for the sources analysis period at the time.
Okay. Now, it feels impossible to discuss the Great Recession without really focusing heavily on the housing crisis. One source makes a very strong statement saying, quote, "The story of the Great Recession cannot be told without addressing housing."
That statement is absolutely warranted. Yeah, the consensus view is that the Great Recession was largely triggered by the widespread failure and collapse of the subprime mortgage market and the subsequent bursting of that massive housing bubble. The downturn in housing prices that began in late 2006 was not only dramatic, but critically, it was unprecedented in the post-World War II era in terms of its sheer scale and duration.
How unprecedented are we talking?
Look at the numbers again. U.S. households lost over $7 trillion in home equity from the peak in early 2006. That was just a shockwave through household balance sheets.
Incredible.
Compare this to the 4 prior recessions in the 40 years before the Great Recession. In those, the impact on home equity was either pretty minor Or in some cases, home equity actually increased slightly during the recession. The sheer magnitude of wealth destruction tied specifically to housing was a defining feature of the Great Recession.
And that led to that huge problem of homeowners being underwater on their mortgages.
Yes, with home values plummeting like that, a huge number of homeowners ended up owing more on their mortgage than their home was actually worth. By 2012, according to the sources, an estimated 22%, nearly 1 in 4, of all homeowners with mortgages were underwater. That created a truly precarious situation for millions of households.
And the housing crisis was just deeply intertwined with the job losses, too, creating this terrible feedback loop, wasn't it?
Absolutely. High unemployment, job losses, it made it incredibly difficult for many households to keep up with their mortgage payments. Combine that with negative equity, meaning they couldn't even sell the house without taking a massive financial loss, and many homeowners were pushed towards delinquency and foreclosure. And then you had other factors contributing too, like predatory, high-cost mortgages that were common then, personal adverse events like divorce or illness, and even some strategic defaults where people just walked away from deeply underwater properties. All this fueled the wave of foreclosures.
What was the scale of mortgage delinquency during this crisis? How bad did it get?
By the second quarter of 2011, a staggering 7.9% of all residential mortgages were seriously delinquent. That means 90 days or more past due, or actually in the foreclosure process.
Almost 8%.
Yeah. That scale of distress in the housing market is exactly why the sources describe it as a housing crisis of unprecedented magnitude.
Okay, so the anatomy involves shrinking activity, rising unemployment with lasting scars, shifts in spending, and in the Great Recession, this central, devastating housing collapse. But these impacts, they aren't distributed evenly across the population, are they? Some groups suffer much, much more than others.
That's a critical and often painful truth about recessions.
Yeah. One source introduces the concept of the Matthew effect in this context. The Matthew effect.
Yeah, the idea that downturns tend to hit the already disadvantaged or vulnerable populations particularly hard, especially exacerbating existing inequalities, like the rich get richer and the poor get poorer, but in reverse during a crisis.
Got it.
And micro-level data from the Consumer Expenditure Survey, comparing spending patterns during the Great Recession, 2007-2009, to a pre-recession period, 2003-2006, gives us some specific insights into how different demographic groups were affected.
Okay, let's look at the consumption impacts based on age and education first. What did that data show?
The data reveals that middle-aged individuals, specifically those aged 31 to 64, experienced some of the largest declines in consumption growth, actually regardless of their education level. Both those with a high school education or less and middle-aged college-educated individuals saw their consumption growth rates drop significantly in the range of about Medicare 3.9% to medical 4.4%. And the largest negative turnaround compared to their pre-recession trends was also seen for the high school or less educated group and that middle-aged college-educated group.
That middle-aged college-educated group result is surprising. You might think they'd be more financially stable, maybe less affected. Why did they see such a large negative turnaround in their spending?
Yeah, that's one of the really interesting findings from the microdata. The source suggests it's largely due to that wealth effect we talked about earlier.
Okay.
Middle-aged, college-educated households, they tend to hold a disproportionately large share of both financial assets, like stocks, and often significant home equity. So the massive wealth destruction during the Great Recession hit this group really hard on their balance sheets.
Right.
This significant loss of wealth was strongly correlated with the large negative consumption growth they experienced. It basically impacted their ability or maybe their willingness to spend by just depleting their financial buffer.
Okay. How did consumption impacts differ by race or ethnicity according to the data?
The data shows that the Hispanic population experienced the largest consumption decline overall, down 4.9% during the recession period compared to the control group. They also saw the largest drop in consumption growth relative to their pre-recession trend.
Any reasons suggested for that?
The source suggests a couple of possible reasons. Maybe a potentially higher reliance on wage and salary income, which is obviously more vulnerable to job losses during a downturn, and also a higher projected proportion of Hispanic homeowners ending up with negative home equity, meaning the housing wealth decline hit this group particularly hard.
And self-employed individuals also saw significant impacts on their spending.
Yes, the self-employed saw a substantial drop in consumption, down a striking 10% according to the survey data. Their income is often much more directly tied to overall economic activity and business conditions, making them particularly vulnerable during a contraction.
Okay. Now, the findings related to income and wealth levels were quite notable, too. The report mentioned the fall in consumption was higher at higher income levels, though maybe not always statistically significant. But the finding about the top decile of the wealth distribution really stood out.
This is perhaps the most counterintuitive finding from that consumption data analysis. You'd normally expect the wealthiest households, right? With their significant assets, they should be best positioned to smooth their consumption during a downturn by drawing on savings or asset values.
Yeah, you'd think.
However, the microdata showed that respondents in the top decile of the wealth distribution actually decreased their total consumption the most. Their mean consumption fell a significant 7.5% during the Great Recession compared to the control period.
Wow. Why on earth would the wealthiest cut back their spending the most?
The explanation provided in the source circles right back forcefully to the wealth effect again.
Really, even for the wealthiest?
Yes. While the wealthy do have significant assets, they also suffered the largest absolute losses in wealth during the Great Recession because of the collapse in stock and housing markets where they held substantial amounts. The average wealth loss for that top wealth decile between 2007 and 2009 was estimated at a staggering $209,000.
Okay, that's a huge hit.
It's a massive shock. It significantly reduced their buffer stock of wealth. So to restore their savings and their sense of financial security after such a large loss, they significantly decreased their spending. The source even cites wealth effect estimates from other economic literature predicting maybe a 1 to 7 cent decline in consumption for every dollar of wealth destroyed, and shows that these estimates can indeed explain a significant fraction of the wealthy's observed consumption decline. The predicted range was nigh to just 1.5% to nigh to 10.5%, and the actual decline they saw was nigh to 7.3%, right in the middle.
So the wealth effect was actually so powerful for the wealthiest that it compelled them to cut spending more than lower wealth groups, who were perhaps more constrained by, say, income shocks and credit access issues.
That seems to be the key insight from this particular data, yes. Those in lower wealth deciles were less directly impacted by the massive wealth destruction because they held fewer financial assets or less home equity to begin with, but they were likely more severely hit by income shocks due to job losses and by those tightening credit constraints that made it harder for them to borrow or maintain their spending levels. Different pressures on different groups.
Did the Great Recession impact consumption inequality or mobility between groups?
Consumption inequality actually declined during the Great Recession because, as we just discussed, consumption fell proportionally more among the wealthy than among the poor. The sort of compression effect temporarily reduced consumption disparities.
Interesting. What about mobility?
Regarding consumption mobility, that's how much households move up or down the consumption distribution over time. There's been this general trend of declining mobility over recent decades, possibly linked to increased access to credit and insurance that helps households smooth out temporary shocks. The sources note that the Great Recession, with its severe credit tightening, may have potentially reverted or slowed that declining trend, because tight credit makes it harder for households to smooth uninsurable income shocks, which could potentially increase consumption mobility. But the data period analyzed wasn't really long enough for a statistically certain conclusion on that specific point.
Okay. Turning to the labor market impacts, the pattern of who tends to lose jobs seems remarkably consistent across different recessions over time.
Yeah, this is another really important finding from the research, yes. Studies looking at labor market impacts across multiple U.S. recessions, going back to the late 1970s, show a very stable pattern. The groups that experienced the greatest percentage job losses during the Great Recession were largely the same groups who were hit hardest in the recessions of the 1980s and 1990s.
And who are those groups that consistently bear the brunt?
Consistently, it's men, Black and Hispanic workers, young workers, especially those just trying to enter the labor force, and less educated workers, those with a high school diploma or less. These demographic groups also tend to experience weaker labor market outcomes, things like lower wages, higher unemployment rates, even during good economic times. So while the Great Recession's labor market contraction was particularly severe and prolonged in its size and length, the type of impact, meaning which groups bore the brunt of the job losses, was sadly consistent with those historical patterns.
And the housing crisis also had incredibly uneven impacts, right? Both regionally and demographically.
Absolutely. Regionally, the price declines were just wildly different. Places like Las Vegas and Phoenix, which had seen these massive housing booms, they experienced catastrophic price busts. Prices fell nearly 60% from their peak by mid-2011 in Vegas.
Ouch.
Meanwhile, other markets like Denver saw relatively minor declines, less than 10%. Also within markets less expensive, sort of entry-level properties often saw bigger price swings, both larger appreciation during the boom and then larger declines during the bust than more expensive homes.
And the racial and ethnic disparities in the housing crisis were particularly severe, weren't they? Compounding existing inequalities.
They were devastating. Black and Hispanic households experienced disproportionately larger losses in home equity and overall wealth. The data cited is just stark. Median wealth for Hispanic households fell a staggering 66% between 2005 and 2009.
66%?
Yeah. For Black households, it fell 53%, while for white households, it fell only 16%.
That's a massive gap.
It's a huge disparity, and it was linked partly to higher rates of subprime lending in minority neighborhoods, which made those borrowers more vulnerable to default when the market turned. That led to sharper increases in foreclosures and deeper equity losses in those communities.
And this then led to sharper declines in homeownership rates for minority groups, too.
Yes. Following the housing crash, homeownership rates declined more sharply for Black and Latino households compared to white households. Homeownership also fell more significantly for young adults compared to older adults. That reflected fewer young households being able to transition into ownership during that period, while older owners were perhaps less likely to exit homeownership.
What about renters? They weren't dealing with negative equity directly, obviously, but they were still impacted by all this housing market turmoil.
Yeah, they faced different but still significant challenges. As homeownership became less accessible and foreclosures pushed some households back into the rental market, demand for rentals actually increased.
Ah, right.
This, combined with declining incomes for many households due to job losses, led to an increase in severely rent-burdened households, those paying more than 50% of their income just towards rent. This hit low-income renters particularly hard, left them very vulnerable. And housing assistance programs just weren't able to keep pace with the surging need.
So beyond the obvious financial costs, foreclosure, wealth loss, were there other, maybe more hidden costs associated with the housing downturn that the sources highlight?
Yes, the sources really emphasize that housing is much more than just a financial asset, right? It's central to household well-being, community stability, access to opportunity. So a recession triggered by a housing crisis has these troubling spin-off effects.
Like what?
Well, studies indicate worse health outcomes for families experiencing the stress of foreclosure or housing insecurity. Neighbors of foreclosed properties also suffer. Vacant homes can lead to reduced property values for surrounding homes, potentially increased crime rates in the neighborhood. And on a societal level, homelessness among families rose significantly by an estimated 30% between 2007 and 2009, with families also spending longer periods in shelters. These things highlight that a housing-centric recession has broad, deep consequences that go way beyond just the financial balance sheet.
That paints a very clear and sobering picture of the human cost and the unequal burden of these downturns. Let's shift gears again now and look at how investments typically fare during a recession and what the sources suggest about navigating these periods.
Right. When economic activity contracts and uncertainty spikes, it fundamentally changes the landscape for investments. The general pattern we see is that fixed income assets, primarily bonds, tend to perform relatively better during downturns compared to riskier assets. Conversely, assets like equities, stocks, and commodities tend to perform poorly. And across pretty much all asset classes, you typically see an increase in volatility as market participants react nervously to the changing economic outlook.
Why do bonds tend to do better in a recession?
There are a couple of key reasons. First, as we discussed earlier, the Federal Reserve typically responds to a recession by cutting interest rates, often aggressively, to stimulate the economy. Lower interest rates make existing bonds that pay higher fixed interest payments more attractive, which pushes their prices up.
Okay.
Second, in times of economic fear and uncertainty, investors seek safety. U.S. Treasury bonds are considered one of the safest assets in the world, so you get increased demand for them, pushing their prices higher during downturns as investors flee from risk. The classic flight to quality.
Makes sense. And commodities often perform poorly, especially later in the cycle.
Yes, especially later in a recession. Commodities are, raw materials, oil, metals, agricultural products. Demand for these is closely tied to industrial activity and consumer demand. So when the economy contracts, demand for raw materials falls, putting downward pressure on commodity prices.
What about gold? It's often touted as a classic safe haven, right? A hedge against economic turmoil. How does it actually perform?
Yeah, the sources describe gold as something of a controversial asset in this regard. While it's commonly believed to provide reliable protection during downturns or periods of high inflation or geopolitical tension, its actual performance isn't always consistent.
Hmm.
Gold prices are influenced by this complex interplay of factors: inflation expectations, interest rate movements, especially real interest rates, so rates adjusted for inflation, the strength of the US dollar, and yes, geopolitical events or specific market crises definitely play a role too.
Are there any historical examples where gold didn't act as that perfect hedge during a downturn?
Yes, the sources look specifically at the period around the 1980 recession, which happened during that really challenging stagflation era. Gold had risen sharply in late 1979 and into January 1980, driven by high inflation fears and geopolitical tension like the Soviet invasion of Afghanistan.
Okay.
However, from January 1980 onwards, despite high inflation still lingering, gold prices actually fell sharply and continued to fall or underperform during the 1980 recession itself.
Really? Why the drop then, if inflation was still high?
Well, that period saw the Federal Reserve under Paul Volcker embark on those incredibly aggressive interest rate hikes to combat inflation, eventually pushing the federal funds rate up to 20%.
Right, the Volcker shock.
Exactly. Higher interest rates increase the opportunity cost of holding a non-yielding asset like gold. Plus, the collapse in silver prices in March 1980, remember Silver Thursday, after the Hunt brothers tried to corner the market. That also had a spillover effect, creating selling pressure in gold. So even with high inflation and a recession, other factors pushed gold prices down, showing it's not some guaranteed hedge.
And looking at a more recent period, say leading up to early 2023, when some of these sources were compiled, how did gold perform then? We had high inflation again, geopolitical issues.
Interestingly, despite significant inflationary pressures and major geopolitical tension, like the war in Ukraine, gold's performance wasn't particularly strong in the period leading up to early 2023 either. It faced headwinds from the Federal Reserve's rapid and significant interest rate hikes and the accompanying strength of the US dollar.
So history repeating, in a way.
In some ways, yeah. This recent experience, much like the 1980 example, just reinforces the point that gold is impacted by all sorts of extraneous events and isn't a simple, reliable hedge against all forms of economic stress or uncertainty.
So the conclusion on gold is perhaps it's more of a portfolio diversifier than an absolute guaranteed safe haven.
That's pretty much the takeaway presented, yes. It can provide diversification because its price movements aren't always perfectly correlated with stocks or bonds, but it doesn't offer guaranteed downside protection in every single downturn or inflationary environment.
Comparing these different periods like the 1980s and the environment leading up to 2023, it really underscores that no two recessionary environments are identical, even if there are some surface similarities.
Exactly. The sources draw that comparison explicitly. Both periods saw spiking inflation and rising interest rates. Those are clear similarities. However, the speed and magnitude of the rate hikes in 2022-2023 were described as pretty much unprecedented in modern times.
Right.
Key differences included a much tighter labor market in the lead up to 2023 compared to the early 80s. Peak inflation arrived faster this time around, and the initial and ultimate peak levels of the Fed funds rate were much higher back in the 80s under Volcker.
And asset performance reflected these differences too.
Yes. As we noted, gold performed differently. Commodities, surprisingly, actually had a positive return in the downturn around 2022, unlike in the 80s. That was driven by factors like the spike in oil prices, the war's impact on agriculture, specific industry dynamics. These discrepancies just highlight why historical patterns are useful guides, absolutely, but they're never perfect templates for predicting the future.
Okay, so given that predicting is hard and every recession is unique in its own way, what should investors and maybe their financial advisors actually do when those recession indicators start flashing red, when fear starts to rise? Is it time to just panic and sell everything?
Absolutely not. Panic selling is explicitly cautioned against in the sources, and just by common investment wisdom, it is notoriously difficult to time the market perfectly.
Yeah, almost impossible.
Right. Selling during a downturn just locks in your losses, and you risk missing the crucial early stages of the eventual recovery, which is often when the sharpest gains actually occur. The focus really needs to remain on long-term goals and sticking to a disciplined strategy.
Okay, so if not panic, then what strategic moves do make sense?
Well, for individual investors, it means maybe revisiting your investment strategy, not necessarily making drastic changes, but perhaps rebalancing your portfolio back to your target asset allocation if it's drifted. Some investors might consider a slight tilt towards more defensive sectors, industries like consumer staples, things people buy regardless, like food, household goods, healthcare, utilities. They tend to be more resilient during downturns because demand for their products and services is less sensitive to economic cycles. High-quality bonds can also serve as a ballast in a portfolio, providing some diversification and stability.
And building or maintaining cash reserves seems like crucial advice, too.
Absolutely. Having a sufficient cash buffer, or dry powder as it's sometimes called, is vital. On a personal finance level, it provides security if you face potential job loss or unexpected expenses without being forced to sell investments at the worst possible time.
Good point.
And on an investment level, it also creates the opportunity to potentially buy assets at lower prices if the market falls significantly, effectively averaging down your cost basis over time. Dollar cost averaging investing a fixed amount regularly, regardless of price, is another strategy that helps remove emotion and ensures you buy more shares when prices are low.
And focusing on the fundamentals of the actual companies you're invested in becomes even more important.
Crucial, yeah. In times of economic uncertainty, companies with strong balance sheets, meaning low debt, sustainable earnings streams, durable business models, solid management, they're generally better positioned to weather the storm than highly leveraged or more speculative ventures. Quality tends to outperform when times get tough.
For financial advisors guiding their clients through this uncertainty, what's their main role?
Their role is primarily about proactive communication and guidance. They really need to reach out to clients before the peak of any panic sets in. Explain the economic environment, talk about the indicators, show how the client's portfolio is positioned relative to their long-term plan and their risk tolerance. It's a time to revisit those financial plans, maybe stress test portfolios to show clients how they might perform under different potential downturn scenarios. And, crucially, provide education. Remind clients that economic cycles are normal. Recovery always follows contraction eventually. Help them distinguish between signal and noise among the endless news headlines. And advise them against making impulsive emotional decisions based on short-term market volatility.
So the ultimate message is that perfect market timing is basically impossible, so preparedness and discipline are really key.
Exactly. The market doesn't wait for some all-clear signal. It often starts recovering when the economic news still looks pretty grim. The goal isn't to predict the bottom precisely and jump back in at the perfect moment. It's to have a strategy, have the discipline to stick to it, maintain your capital through the downturn, and be positioned to participate in the eventual recovery. Acknowledging that even the expert opinions on the future are always divided is part of taking a realistic approach.
Okay, let's turn now to the policy response. When a recession hits, or looks imminent, what tools do the Federal Reserve and the government actually employ to try and counteract it?
Right. So the Federal Reserve, the U.S. central bank, has what's called a dual mandate from Congress: promote maximum employment and maintain stable prices. During a recession, with unemployment rising and potential deflationary pressures, although deflation is less common now, the Fed acts primarily to stimulate economic activity and bolster employment. They also play a critical role in providing emergency support and stability to the financial system if needed, as we saw them do dramatically during the Great Recession.
Why is the Fed so concerned about prices falling too much deflation during a recession?
Their big concern there is something called debt deflation. This happens when falling prices increase the real value of outstanding debt. Think about it. If asset values or your income fall, but the nominal amount of debt you owe stays the same, the burden of that debt gets much heavier. This can be particularly risky for banks and other financial institutions that hold large amounts of debt. It could lead to defaults, financial instability. So the Fed acts in the name of stability to try and prevent a widespread financial crisis caused by that kind of debt deflation spiral.
Okay. What are the main monetary policy tools the Fed uses to stimulate the economy?
Their primary tool, historically and still today, is open market operations. This involves the Fed buying government debt securities, mainly treasury bonds, in the open market.
How does that help?
When the Fed buys bonds, it injects money into the banking system. This increases the supply of reserves banks hold, which pushes down the federal funds rate. That's the target rate at which banks lend reserves to each other overnight.
Okay.
A lower federal funds rate generally translates into lower borrowing costs throughout the economy. For businesses and consumers, think mortgages, car loans, business loans. The aim is to make it cheaper to borrow, which hopefully encourages businesses to invest and avoid layoffs and consumers to keep spending.
And when those short-term interest rates basically hit zero, like after the Great Recession and again during COVID, they use something called quantitative easing, or QE.
Yes, quantitative easing, QE, is a less conventional tool they turn to when the federal funds rate is already near zero and can't really be cut any further. With QE, the Fed buys longer-term bonds and sometimes other assets like mortgage-backed securities on a massive scale.
And a goal there.
The goal is to pump even more liquidity into the financial system, try to lower longer-term interest rates more broadly, not just that overnight federal funds rate, and encourage lending and investment that way. It's a way to provide additional monetary stimulus when the primary interest rate tool is constrained. It was used extensively after the 2008 crisis and again during the COVID-19 pandemic.
Can they also adjust bank capital requirements? Is that still a tool?
Historically, the Fed could adjust reserve requirements for banks to influence the amount of money available for lending. However, as the sources note, there's less room to use that specific tool now, especially after reserve requirements were effectively eliminated during the COVID response. So, less focus on that one these days.
What about lending directly to banks?
They can do that too. The Fed provides direct loans to banks through its discount window. This serves as an emergency backstop, allowing banks facing short-term liquidity issues to borrow directly from the Fed.
Okay.
Historically, the discount rate was set above the federal funds rate to discourage banks from using it routinely. But in recent decades, the practice shifted towards using the discount window more flexibly to support the financial sector when needed. The Fed acts as the lender of last resort for the banking system, which is a crucial role during a crisis. The discount rate was dropped to a record low of 0.25% in March 2020, but had risen significantly again by early 2023 as the Fed was hiking rates to fight inflation.
And finally, their communication itself, just what they say is a tool, right? Expectations management or forward guidance.
Absolutely. The Fed understands very well that its words and its announced intentions can significantly influence market expectations and behavior. Through public statements, meeting minutes, speeches by officials, they try to signal their likely future policy path. This helps reassure markets during times of stress and prevent excessive pessimism from becoming a self-fulfilling prophecy. This management of expectations or forward guidance is a really important tool, especially when those traditional interest rate tools are constrained near zero.
This really highlights a key dilemma for the Fed, doesn't it? Especially in environments like the one leading up to 2023, the fundamental conflict between fighting inflation and fighting a potential recession.
It's the central challenge, yeah. Expansionary monetary policy cutting rates, doing QE, is designed to stimulate the economy and fight unemployment. But if the economy is already strong, or if there are supply-side issues causing inflation, injecting more money and lowering borrowing costs can just fuel more inflation. Conversely, the policy needed to fight high inflation, raising interest rates, tightening credit, quantitative tightening or QT, intentionally slows down the economy. That increases the risk of causing a recession or making an ongoing one worse.
And the worst case scenario is stagflation, where you get the worst of both worlds. High inflation and high unemployment with slow or negative growth.
Stagflation is a monetary policymaker's absolute nightmare because the tools directly conflict. Stimulating the economy to reduce unemployment is likely to worsen the inflation problem. Fighting inflation by raising rates is likely to slow the economy further and increase unemployment. It's an incredibly difficult balancing act with no easy answers.
It made the situation in the 1970s, which saw significant stagflation in the U.S.
That era, partly triggered by oil price shocks but also other factors, is the classic U.S. example. The Federal Reserve under Paul Volcker ultimately decided to prioritize bringing down that high entrenched inflation, even knowing it would likely cause a painful recession. They raised the federal funds rate dramatically, peaking at an astonishing 20% in 1980. This aggressive tightening did indeed contribute significantly to the steep recession we saw in 1982, but it eventually broke the back of inflation. It demonstrated that sometimes resolving severe stagflation might require deliberately accepting or even inducing a recession to bring inflation back under control. A really tough choice.
Okay, so that's the Fed's monetary policy. Beyond that, the government itself also uses fiscal policy, right?
Yes, fiscal policy is the realm of the government, Congress, and the president, and involves using government spending and taxation levels to influence the economy.
How does that work in a recession?
During an economic slump, the government can implement expansionary fiscal policy. That means either increasing its own spending, maybe on infrastructure projects, social programs, aid to states, or cutting taxes. The goal is to inject money directly into the economy, boost aggregate demand, and try to counteract the drop in private sector spending, thereby supporting jobs and overall economic activity.
Examples would be things like stimulus packages or expanding unemployment benefits.
Exactly. Things like the stimulus spending under President Kennedy back in the early 1960s, or the expansion of social safety nets like Social Security and unemployment benefits over time. A particularly valuable component of fiscal policy during downturns are what we call automatic stabilizers.
Automatic stabilizers.
These are government programs or features of the tax system that automatically increase government spending or reduce tax collection when the economy slows down without requiring specific new legislation to be passed each time.
Like unemployment insurance, maybe. When people lose jobs, they automatically start getting benefits.
Precisely. Unemployment insurance is the prime example. When unemployment rises in a recession, more people automatically qualify for benefits, leading to an increase in government transfers going to households. Similarly, tax revenues automatically fall as individual incomes and corporate profits decline. These automatic stabilizers are valuable because they provide immediate support to those most affected by the downturn. And because those receiving the funds are likely to spend them relatively quickly, they provide a timely boost to aggregate demand, helping to cushion the economic blow without legislative delay.
And what about targeted relief or bailouts for specific industries? We saw that in the Great Recession.
Yes, that's another form of government intervention. It involves providing financial aid or support directly to specific sectors or even companies deemed critical to the economy or facing imminent collapse, like the auto industry bailout during the Great Recession, 2008, 2009.
Well, they're always controversial.
Very often, yes. Supporters argue they save jobs and prevent a wider economic contagion. Critics raise concerns about the government picking winners and losers, creating moral hazard where companies take excessive risks knowing they might get bailed out, or just the fairness of using taxpayer money for specific companies. But, controversial or not, they are a tool the government has used during severe crises.
So, to sum up the policy response, you have the Fed using monetary policy, focused mainly on interest rates and the money supply. And then you have the government using fiscal policy, focused on spending and taxes. Both are brought to bear, sometimes facing that difficult trade-off, especially in complex situations like stagflation.
Correct. They are the primary policy levers used to try and manage the economic cycle, smooth out the bumps. Though, of course, the effectiveness, the appropriate mix of policies, the potential side effects, those are subjects of ongoing debate among economists and policymakers.
Okay, we have covered a lot of ground in this deep dive. Let's try and bring it all together now and summarize the key takeaways about the anatomy of U.S. recessions based on everything we've discussed from these sources.
All right. Well, we've seen that recessions are fundamentally periods of significant, widespread contraction in economic activity. They're marked by quantifiable declines in GDP, often sharp rises in unemployment with potentially lasting scars, and distinct shifts in how households spend their money. The Great Recession provided a really powerful recent case study. It demonstrated just how deeply these downturns can be intertwined with financial crises, particularly a housing collapse of truly unprecedented scale. And that brought not just direct financial costs, but also broader, sometimes hidden impacts on well-being and communities.
And crucially, that uneven impact.
Crucially, yes. We've highlighted how the burden of these contractions falls unevenly across the population. Specific vulnerable groups defined by age, education, race, or ethnicity, or how exposed they were to wealth destruction or credit constraints, tend to suffer disproportionately, often worsening existing inequalities.
And predicting them accurately remains a huge challenge, but maybe not an entirely blind quest.
Precisely. Predicting the exact timing. That's still incredibly difficult, the holy grail pursuit, as we said. But we do have powerful, historically reliable indicators like the inverted yield curve, signals from the stock market, tightening credit conditions. These serve as valuable warning signs. The key insight here, though, is that relying on just one indicator is risky. The most prudent approach involves looking for that confluence of signals across multiple diverse measures.
And navigating these periods both from a policy perspective and a personal financial perspective.
Yeah, both the Federal Reserve and the government employ their monetary and fiscal policy tools, sometimes facing those really difficult trade-offs, particularly when high inflation complicates the picture, as the 1970s stagflation example showed us so clearly.
Right.
For individuals and investors, the sources and the historical data really underscore that while perfect prediction is impossible and every recession is unique in its details, understanding the underlying dynamics, the potential impacts, and the historical patterns is crucial for preparedness.
What does that preparedness look like?
It means having a disciplined strategy, avoiding emotional reactions like panic selling, maintaining financial buffers like cash reserves, focusing on long-term goals, and paying attention to the quality of your investments. It's really about navigating uncertainty based on knowledge and discipline, not letting fear drive your decisions.
The sources really seem to emphasize that while we can dissect the patterns of past recessions, the anatomy, if you will, their severity, their duration, their precise impacts, are always shaped by the specific context and triggers of that particular time. That makes each one unique. Yet that consistency in who tends to be hit hardest across different cycles is a powerful, if quite sobering, takeaway. Preparedness built on understanding these recurring patterns and the potential for those uneven impacts is perhaps the most valuable defense against the inherent uncertainty of the economic cycle.
Absolutely. I think that's well put. Knowing the general anatomy of the storm helps you understand the potential damage and how best to reinforce your defenses, even if you can't know exactly when or precisely where it will make landfall next time.
So here's a thought to leave you with as we wrap up. We've taken this deep dive into the anatomy, we've sliced into the data, identified the classic warning signs, explored the uneven impacts, reviewed the policy tools. We can describe the engine of contraction, understand its effects on different parts of the system, different groups of people.
Yeah, we've covered a lot.
Yet, despite all this detailed knowledge gleaned from history and analysis, the exact timing, the specific trigger, the precise character of the next U.S. recession remain fundamentally unknowable ahead of time. It highlights this enduring tension, doesn't it, between our very human desire for certainty in a complex system and the reality of inherent economic uncertainty. It reminds us that perhaps the ultimate goal isn't achieving perfect prediction, which might be impossible, but rather building robust knowledge and resilience that allows us to navigate whatever comes next, whenever it arrives.
That's a very insightful point to consider as we finish. Well said.
Thank you for joining us for this deep dive into the anatomy of U.S. recessions. We hope this exploration of the signs, the impacts, and the duration has provided you with a clearer, more informed picture of these critical, albeit often challenging, economic events.
Thank you. We definitely encourage you to continue exploring these complex and vital topics and, just stay informed.
We'll see you on the next deep dive.